and gentlemen, welcome. Welcome to this Business Day Dialogue in partnership with Growthpoint Investment Partners, which is, for me, also a new brand. So I think for many of you as well, might be a brand that you're still learning about. Growthpoint's obviously a very well-established brand. My name is Michael Avery, and it's a great pleasure to be your MC and facilitator today. I'm not going to bore you with too many details about myself, apart from the fact that I've got a 6-year-old and a 9-year-old. 2-year-old, I'm pleased she's not 2 anymore and out of nappies. But my partner's got an 18 and a 20-year-old. So I've got a bit of insight into the struggles around student accommodation. And the 18-year-old wants to go to UCT next year. We were just at the open day, and I can tell you there's a huge mismatch between supply and demand. And the 20-year-old's actually in Dublin at Trinity College studying engineering. And it's not an isolated problem, this. I can tell you, if you want to invest in any asset class in Dublin, go and develop student accommodation, because it's probably harder to find in Dublin than it is in Cape Town. So these are not localized challenges. These are global phenomena. More people want to study, more people want to further their prospects in life. And what did Nelson Mandela say about education being the most powerful force in the world with which to transform the world? And I think student accommodation is certainly an area that speaks to that. And it's an emerging asset class that offers huge opportunity. But also, as we know, in South Africa, it does come with some challenges. We'll unpack some of those through the course of the day. What's going on with the caps around NSFAS, but also the big opportunity for the private sector to partner with government, to partner with academia in providing student accommodation. And I think for investors with a long-term time horizon, pension funds, for example, it really is a very attractive asset class in terms of its liability matching, it's long-dated, it's predictable, stable cash flows. But a few things really need to happen in order to unlock that. And I think Growthpoint Investment Partners, and we'll hear a little bit more about that later on, is really leading the way in unlocking the potential there. We're going to be talking to the Thrive Student Living model, which is the student-facing brand of Growthpoint Investment Partners offering in the market. We're going to get a dipstick into what's happening around the world, in Australia, in the UK, and in the US as well, just to contextualize the discussion within the global discourse around student accommodation and student living. And then we're going to end off with a panel discussion with some asset allocators, just figuring out their investment committee processes and why they invested in the asset class and how they're thinking about the future and future allocations that they might be making. So just some housekeeping as we welcome our online delegates as well. And we ask the gentleman who's delivering the coffee, please be mindful of those delegates, because we are filming them from the back. So if anyone as well does need to get up and make use of the lavatories, please try and get out and away from the cameras, because we are streaming this as well. So welcome to everyone who is tuning in remotely. The lavatories are out the door, if you haven't seen them yet, all the way on the other side of the main restaurant area to your right. You'll see the gents and the ladies is over there. The Wi-Fi password is level par, something I've been struggling with for some time in my golf game, and it's under HGC Guest. If you haven't logged on to the Wi-Fi, just get on to HGC Guest. It's all lowercase, and it's level par, one word, to access that. We'll also give you an update a little bit later on about the site visit. We just wanted to see final numbers. I know registration was closed, but if there are a few people that perhaps couldn't make it today, we might have 1 or 2 spots available if there are a few of you who still want to go and kick the bricks physically of some student accommodation in Braamfontein. That is one of Growthpoint Investment Partners' key assets. Well, with that, really my privilege to introduce our first speaker for the day. George Muchanya, who's going to share a little bit more about who Growthpoint Investment Partners is. And as I said earlier, I think the Growthpoint brand is very well known, but very interesting to hear a little bit more about Growthpoint Investment Partners and what they're doing. He's a specialist in M&A, has been for the last 25 odd years, although you wouldn't say so looking at him. And since joining in 2005 at Growthpoint, he's played a real key role in implementing the strategic vision. So a warm round of applause, everyone, for George.
Morning, everyone. It's great to see a lot of familiar faces, and it's also good to see as well a lot of the investors that are in the room. And thank you very much to those that have made the time that are available online. It's not often that people find 2 hours to come and listen to us, but the level of attendance shows the level of interest that there is in this sector, which we believe is very interesting. A lot of people know about Growthpoint, fairly known brand within the property sector. Growthpoint Investment Partners really was an attempt, or is an attempt by Growthpoint to focus more on the alternative side of the business. A lot of the investments in Growthpoint are on balance sheet investments, but what became very apparent in the last few years was that investors wanted more than the office, retail, and industrial. That's when then we created Growthpoint Investment Partners. We internally are a ring-fence division. There are quite a few of us here. A lot of you would probably know Itu. Itu, I can't see you here somewhere. Itu Meleng is one of the key leaders in that business, who's focusing more on the business development side. I've got Amu, who come onto the stage earlier. Our role really is around thinking of new ideas, finding asset classes within the property there that investors want, and making sure that we create those into institutional type of products. And we're going to go through some of those that we already have. In essence, we're adding depth to the sector. If you look until 4 or 5 years ago, institutions only had offices, industrial, and retail to invest in. Then you started seeing storage, which storage came back about probably into the market about 2018, 2019, somewhere thereabout. That was the first real alternative asset class that came to the market. And what we're doing is similar to what you see everywhere else. Australia in particular has got very strong depth in real estate. Almost everything else that there is in real estate is in Australia is available for institutions. That's where we go looking at going. Heavy reliance on Growthpoint. Growthpoint invariably is always a key anchor investor in here, 15 to 20%. The message that we've gotten from investors a lot of the times was that there should be and there needs to be proper alignment between what the manager is and the manager having skin in the game with the rest of the investors. So it's a commitment that Growthpoint has given in the current platforms that ensures in some way alignment. Another key important part for us was secondment of C-suite executives, particularly when it comes to the investment committee. And again, when we created this in around 2018, the key message that we got, particularly from the asset consultants, was that they wanted to the knowledge that the key executives have imputed into the underlying platforms. So what you find then in terms of our own platforms there, we still rely on the key execs from Growthpoint sitting in the investment committee and in 1 or 2 of the boards as well. Brand and policies and all that stuff from a risk management point of view is a key reliance on that. One of clearly the key competitive advantage that Growthpoint Investment Partners have is on-ground offices in Joburg, Durban and Cape Town, and that's originally good. That's good for deal origination. Just gives you a feel of the platforms that we have. Assets of about 19 billion. The student REIT, about 3.5 billion. Healthcare REIT, about 3.8 billion. A lot of you will be familiar with some of the hospitals that we own. We own Busamed Hospitals down in Durban, Netcare Hospital in Cape Town, and the Mediclinic Hospital in Cape Town, and state-of-the-art hospital there in Pretoria called Sintocare. That's about 3.8 billion. Lango is Africa, as you can see from the map there. Ex-South Africa, it's a JV with 91. We be the joint managers there. Grown very significantly over the past few years, about 650 million USD in GAV. So that's doing nicely there. One thing and one message that we got from investors was that in any of these platforms, they always want a point of exit. So each of these here have got definitive path, and that definitive path to exit is driven either by size, target size, or by passage of time, so that at least there's always guaranteed exit by investors. We have aspirations to launch another platform in the next 12 to 18 months. Our whole existence as GIP is to make sure that we find these niche asset classes that we institutionalize, so that investors then come and invest on those, scale them up, and we'll touch some of those themes that are coming on. Key question that a lot of investors have asked previously was, why is this not on Growthpoint's balance sheet? The answer is simple, that investors want specific exposure to a specific asset class. Growthpoint has got about 175 billion balance sheet, and if we are going to put any of these in there, there is very little access then to the specific investment theme that investors want. So that's primarily one of the key drivers why we said these are separate platforms here. This year just shows you that we've got fully dedicated investment team, fully resourced. They've got deal origination, we've got investment side, we've got the support side, finance and compliance and all those things, COSEC. Just to reassure investors here, for those investors that are in here, that this is not something that's really done by some secondary team with Growthpoint, but fully dedicated professionals that are in there. Strong BE credentials, both at Growthpoint level, level 1 BEE. Our pride really is more on the ESD side, enterprise and supply development, through Property Point. That's where really we've made a significant difference there. We have incubated a lot of businesses, and a lot of them, then we give them work internally to make sure then that they get the right level of experience and they get that reference from Growthpoint, and hopefully that really opens more opportunities for them. That's where we believe we're making significant difference there. Over time, this has developed to be like an industry body where our competitors also bring their money as well, and in there we bring critical skills. We train the people, and the key criteria for our competitors is that they open their procurement as well. So in time, we now sort of, it's now becoming an ecosystem. Across each of the platforms, we also have in the management company, we also have B at Manco level there, Lango 10%, Healthcare REIT 15%, Kakiso partner there, and in the student REIT we've got about 20%. So those are the multi-levels there where we have that. Our very existence, as we said earlier, is around unlocking new opportunities. If we speak to a lot of investors, and there are quite a few of you in here, the moment you hear property or real estate at this stage, it's like a swear word. Right? But as we've gotten to dig deeper in the market, we actually realize that there is a lot of money that's going to real estate. The difference is that it's now very selective. If you look at the traditional asset classes, offices, no one wants offices globally. It's not a South African story only. There's a lot of structural changes there, work from home, is related to a lot of supply. You go to Santon, and again, the same theme repeated in London, repeated everywhere else in New York and everywhere. Retail, same story as well. There are a lot of structural changes, online shopping. UK, online shopping accounts for about 20-25% of all sales. If you go to London, Oxford Street, Regent Street, we've never seen vacancies before, but if you go, then there's quite there were vacancies, at least when I was there in October, September last year. That just shows you the change in dynamic and structure dynamic that's happening there. And that's clearly impacting the rentals, that's impacting the valuations and all this, and the filtering in, and investors, for good reason, don't like that. They're liking the sector. Logistics, given the online shopping and all that, I think it's still in flavor. But what happened pre-COVID is that the yields compressed very low. So investors are stepping back a little bit because of valuations. Then Killian is going to touch a little bit more on that. Where we're seeing opportunity and significant opportunity, and which is where a lot of money is going here, is on alternative side. Data centers, you can never have enough of them. Every investor wants to invest in data centers, and that's a global theme. Life sciences, another huge theme globally. We've got a small version, we've got some version of it here through our healthcare fund. Telecoms, whether it's fiber, it's cell phone towers, big investment going in there. Self-storage, I have to say that we were quite surprised here as Growthpoint to see that storage picked as much as it did, because whereas we understand the constraints offshore, where people have got small houses and life and everything is compact, here everyone else has got a garage and they've got a spare room, but we're quite surprised about how storage has picked up. So here storage is doing very well in the sector that's doing very well globally. Where a lot of money is going offshore is in the living sector. And there is the build to rent. Rent to rent is equivalent here is affordable social housing. That market is doing exceptionally well. The key difference between here and overseas is that there's scarcity of land offshore compared to here. So here, although there's a lot of demand, there's also a lot of land, and you see a lot of expansion going over everywhere else. One asset class that's also proving exceptionally well, and Michael touched a little bit on it earlier then, Killian's going to touch on it, is student accommodation. That's one sector where there is a lot of opportunity, and that we can see that here locally as well. And certainly that's a sector that's interesting. One thing that makes this sector unique is that a lot of investors always talk about infrastructure. They want financial returns. And this one here offers both the infrastructure part and offers the social returns part, which is key. And it's proven globally, and generally what we always see is that the themes that start in Europe, America, translate and come to South Africa 5-10 years later on, and we're beginning to see a lot of these themes here, and certainly student is one of them. The PBS asset class is one of them. And the way I would like to think about this asset class here is not dissimilar to the REIT market in South Africa. The investors that made money in the REITs in South Africa are the investors that came in when the sector was just starting around the 2003, 2004, 2005. Literally, the early bird always catches the worm. So there was a proper run in there between about 2003, leading to about 2016, 2017. Property, for those that are in the market and that follow the markets, consistently, property was the outperformer. So I think it shows there that time in the market, well, the entry point in the market always important. And we see the asset classes around this year, in being in the same spot that the REITs were at the time. Strong sector fundamentals, and my colleague here, Amo, is going to touch a little bit about that, and using Thrive Student Living as a proxy for the sector. One thing that we find about the sector here is that the sector is not well covered yet. We don't contribute any of the industry stuff, unlike what you see in the other sector. And certainly, I see Ndumiso sitting at the front there as PSHA board. So that's one of the things that we're looking at doing to make sure that we also start combining all our information, contributing to MSCI, so that we start creating industry benchmarks, which makes even more the sector more interesting and more transparent, more information to investors, and that will go a long way. The one part that I want to focus and emphasize on is the social infrastructure part of it. If you look at the money that came into the sector in the last 3-4 years, about 5 billion, there's no single asset class other than two big developments that are happening, one Amazon down in Cape Town and the Reserve Bank in Pretoria. Other than that, there's no single other institutional asset class that has attracted significant capital. This one has. Growthpoint alone, in the last 2 years, we invested about 2 billion in different properties in this sector. Shows you that there's a lot of momentum there. If you go, and some of us are going to join here with the trip in Braamfontein. If you go to Braamfontein, had it not been investment in student accommodation in the first few years, that part of Braamfontein would have been derelict. You can see the difference that it makes. You do the same, go to Hatfield, you go to Auckland Park in Johannesburg, you go to Cape Town CBD, Eris invested about 2.5 billion there. If it wasn't for some of the investors in here that are giving us that money to make all that possible, all those areas would have been derelict. So for me, that's proper impact. And thanks to those investors that have taken the leap of faith to invest in the sector. If you also look at the municipal values, the rates and taxes and development of infrastructure and all that comes with it, there's some of the positive impact. You only need to go, and some of us will see there when we go to Braamfontein, we're building a building next to the one that we're going to see now. If you go and see there the number of people that are on the construction sites, the small bucky suppliers that are there, the small businesses that are there, you can see there that this is a labor-intensive sector, and you can see the benefits that come from investing in infrastructure, translating onto transmitting money from pension funds right down to the people in the street. Industrial and manufacturing output, steel industry. If you look at the number of bricks that are being manufactured, those things take a lot of bricks. If you look at the number of beds and mattresses, and one of the key things for us is that when it comes to beds and mattresses and all that small stuff, we're tendering from small SMMEs because it's an opportunity to grow small businesses, and that's huge impact. For students themselves, I mean, we all know here, every single January and February, without fail, you always see videos and videos of students that are either sleeping in the halls or standing in the streets. So this year is bringing new additional stock to market, and with proper conducive study environment, the outcomes will also be better. So with that as context, just to reinforce there, add on to what Michael said about today's objectives, I think my part here was introducing Growthpoint Investment Partners. I think a lot of you are familiar with Growthpoint, and this is one of the divisions within Growthpoint. To give a global perspective of PBSA, people know anecdotally about PBSA in South Africa. They know the shortage, but I think always a global context is important, and Killen is going to do that. My colleague Amo here is going to give context more around the performance of the PBSA locally, around rental growth, around the occupancies, all that. What we've also done here is, I know here, and from my trips with E2, there are a lot of investors that like the sector, that are still sitting on the fence, that are not sure whether to invest or not. So what we have done is we've invited some of investors that already invested here in the sector to give their to give their views in terms of the discussions that happen in the IC, how they managed to get their ICs to commit capital here in spite of the perceived NSFAS risk. And what we have done is we've also invited investors that are invested in competitor platforms. So hopefully that gives you a little bit of comfort there around some of the people that are in. Addressing perceived NSFAS risk, we've got Larato here, who at some stage was with NSFAS. He gave us a lot of insights there around some of the dynamics that are happening there, and we hope that you give a view. Investors always ask us, what if NSFAS disappears tomorrow? And you will hopefully answer some of those questions there. We're going to visit Apex Studios. For people my age, I mean, seeing what this is, accommodation is, I wish I could go back to university, because this is very different certainly from what a lot of people my age stayed in during the time. And it would be very good for investors to have a proper, full appreciation of what this asset class looks like, because this is the next phase we institutionalize in the sector. Hopefully, after all that, for those investors that have been sitting on the fence and contemplating whether or not they should invest in the sector, hopefully that gives you enough information to invest the capital here in the sector. So thank you very much. I appreciate you coming along, and I'm sure we'll chat later on.
Thank you very much. I'm going to hand that over to Killen and Lorvu, who will remember, Killen, just before I read out your CV, and you'll be known to many in this room and those watching, I'm sure. Back in the mid-2010s, I think, when all the property companies were raising capital at premiums to NAV, and I think the only people who were happier were the Daytona dealership at Melrose Arch. But how times have changed, and I think The important point for me, certainly, that George raised there is that, investors can't tar the entire asset class with the same brush. There are pockets of specialization that offer really attractive opportunities for long-term patient investors looking for impact. That brings us to the global view, and Killen Ndlovu, who's now more of a consultant than an equity analyst, who started out his career with Standard Bank and then moved to Stanlib, as I'm sure many will know, and is now very involved in advising property companies and asset consultants on the asset class. And Killen Ndlovu is going to give us a global overview of what we see in terms of student accommodation around the world. A warm round of applause, everyone, for Killen Ndlovu.
Thanks, Mike. Good morning, everyone, and good morning to those watching virtually. So we're going to touch about the global markets. There's a lot to talk about, so much information from different players across the world. We'll focus more on the UK, Europe, Australia, and we'll touch a bit on the US. So one of the things that you always see when you read reports is about investment volumes, what's happening in the markets, how many deals are being done. So what you see here, in 2022, it was a record year for student housing, what you call purpose-built student accommodation, or PBSA, and that slowed down in 2023. So it's mainly because of different views as well, higher interest rates. It's difficult to make deals, conclude deals when rates are higher, and then pricing as well. When people are expecting rates to come down, as a seller, I'll wait a little bit and say, hopefully the price will get better. And if I'm lending or borrowing from a bank, you're worried about the interest rates as well. So it's that timing as well as the geopolitical tensions. But despite that, it's not about just the volumes. It's important to focus more on the fundamentals. So I'll break it down into different markets. I'll start off with Australia. Most of us are quite familiar with Australia, with sports or cricket or rugby, and we've got relatives there as well. I've traveled quite a lot, and Growthpoint does have exposure to Australia as well in the other sectors. So what's interesting about Australia is that international students, or just education, is a very big driver of the Australian economy. Just to give you an example, Australian economy grew by 1.5% last year, and more than half of the GDP growth was driven by students, which is tuition fees and spending. And you can see that number going to continue to grow. Did slow down in 2020, 2021 because of COVID, and that's accelerating in 2024. You're going to get a record number of international students coming to Australia and continuing all the way to 2025. On the right-hand side is the number of beds versus the student demand. So you can see from that light brownish color that there's probably much more demand compared to supply. And that's likely to continue all the way even to 2028 and beyond 2028. So big gap between demand and supply. So when you've got demand much more than supply, it drives rental growth. And rental growth, double-digit growth in Australia across different cities, be it Sydney, Melbourne, Brisbane, Adelaide as well. And we expect that trend to continue. And the rents are quite high in Australia. They charge per week, weekly, it's about $500 per week, so almost 2,000 Australian dollars per month. So multiply that by 12, you'll get the rate for how much students pay there. And looking back as well, you can see that the supply hasn't been that huge, and that's why rental growth will continue going up in Australia. And when you've got strong rental growth, the market changed over the last 2-3 years with higher interest rates, which meant higher bond yields. So investors will require a higher rate of return compared to the other asset classes, and we're seeing that office market, retail sector as well, the yields have pushed up. So when yields go up, that means the capital values go down. But whereas with student housing, the yields have remained pretty flat across 2 years, 3 years as well, showing the strength of the student housing market across Australia with that double-digit rental growth. Then move on to Europe. Europe's a similar story. These are more updated numbers to Q1 2024 by JLL. You can see that trend as well. Huge volumes in 2022, slowing down in 2023. And some of the big names, you can see Goldman Sachs, Blackstone as well, involved in the student housing market. So volumes lower than long-term average, but the fundamentals as well, very similar. And I'll touch on the UK. UK is a much more advanced market across the world, and it's the biggest market as well in Europe. On the left-hand side, you can see the number of students, student population. that's been growing all the way to 2034. These are the numbers from the Department of Education as well. They expect that number to continue to grow. But whereas on the right-hand side, let's look at the number of beds in 2024, 2025 at the top there. It's slowing down over the years, yet the number of students continues to grow. And that's helped the UK property sector in terms of student housing. On the left-hand side, let's focus on the total return. You can see student accommodation, positive total returns across between 2020, 2021, 2022, all the way to 2023. And then all commercial property, including all other asset classes, you can see the negative numbers as well in 2023. So much more defensive asset class driven by rental growth. And then capital growth as well, same story as well. All commercial property down 15% last year, whereas student housing is positive 2 to 3%. So it's all driven by huge growth in rents. And from a yield perspective, you're finding that student housing is even trading at a lower yield than all commercial property in the UK. Then move on to Europe, compare that to the other asset classes as well. So on average, you're looking at about 5% net income yield from student housing. So it's got the highest yield, which is quite surprising as well. That the market needs to understand it more because it's giving you better rental growth or earnings growth. So over time, we expect student housing to continue to outperform other asset classes, and it's offering you a much higher yield than other sectors. I'll talk about the residential property market. So student housing is different from your traditional residential property market. But what I'm trying to highlight here is the construction costs. That's difficult to build, given that construction costs went probably high, as much as 20% in some countries over the last 2 to 3 years. At the end of the day, the cost of labor is the same, the bag of cement is the same as well, and that drives actually the valuations over time, that the replacement costs are much higher than the current valuations. And on top of that, you're finding that the permits issued by the councils or the cities as well, they've been declining. So that's going to cause even more shortage of student housing or residential. So residential, you find that students can't get your traditional student housing, they'll move to your traditional apartments, and that's also driving rents in some of those markets. And we've seen our rental growth struggle to catch up with construction costs, and then over time you can see that rental growth has caught up with our construction costs. Because for developers, it has to make sense as well. I can't be building when I'm making a loss, and then you need high rental growth to match that increase in construction costs. And the rental growth has been above inflation in the UK as well as across Europe. So the big question is, who is investing in this sector? And because it's a market that's not really transparent to everybody compared to the listed market. There's not many listed players, but you find that there's a lot of money going into this sector. And it's across different institutions, from specialist fund managers. You're seeing private equity as well. That's the bottom one, the light green line on the left-hand side. And we've got institutions as well, like banks, life companies going into this sector as well. And government, we talk about sovereign wealth funds investing a lot into this sector. On the right-hand side, it's always good to invest alongside your locals. You're seeing more and more domestic money going into the student housing sector because they understand, they can see the problem, you can see the demand for that sector of the market. And some of the big names that you see, you've got Blackstone, there's GIC, you've got Temasek, Brookfield, not just domestic funds or players, it's global, it's across the world, all investing in the European markets, and we expect that trend to continue. And this slide just to give you a visual like how these markets look like. We're focusing on the penetration rates, number of beds per student. And we expect that number to come down because you're getting more students and less beds available going over time. And penetration rate in Australia, for example, is 6%. UK, as I mentioned, is a more mature market, looking at about 45%, and then US about 29%. And then most other markets in Europe, they are less than 8%. Which is going to drive that rental growth going forward. And students, Australia, a big number there, 31%, and the UK, 22%. So on the right-hand side, it just shows what's happened previously across different markets. UK, over the last 5 years, until 2022, you can see that big gap, 150,000 number of beds supplied or delivered, compared to almost 500,000 students. And it's worse when you look at Italy, Spain, Germany, and other markets. And then let's bring this to life as well. If you talk about listed funds, there's not many listed funds across the world. So in America, you'll get the most popular is American Campus Communities and Campus Crest. but I'll focus more on the European markets. The biggest one in the UK is called Unite Group, and the second biggest will be Empiric Student Housing. And then in Europe, there's only one listed player, that's Sheer Student Housing. In Australia, you don't have a dedicated listed property fund. You get it through diversified funds like MEVEC. But these are the biggest players in the UK and Europe. And let's dig deeper and see how they look like in terms of performance. Because you can talk about fundamentals, rental growth, vacancies, but how does that look like in an entity? Let's start with the share price. Share price, pretty flattish for Unite Group, and then Sheer probably a little bit down over the years. But share price is a function of other things, interest rates, market dynamics, relative to the other sectors as well. But in terms of performance, they've done very well, these companies. On the left-hand side, we talk about Unite Group. Occupancies, they were quite low at about 88% during COVID, and they've gone all the way to about 99%. And they're looking at about 98 to 99% for 2024. So they're going to be steady. And then rental growth positive as well. Unite is expecting at least 6% rental growth in 2024. And then Sheer is looking at about 5.5% rental growth, and occupancy is about 98%. So stable occupancies and good rental growth. So if you're getting good rental growth, stable occupancies, that translates to higher earnings. When you've got higher earnings, that means you're getting higher dividends as well. So both companies, you can see there's positive earnings per share growth, as well as dividend growth, dividend per share growth. That's positive for this sector, stable returns. And then I'll look deeper into these numbers as well, so that you understand how listed companies look like, as Thrive Student Living as well, or Growthpoint Investment Partners. They've mentioned that they'll look to list over the years. So some of the things that you need to look out for. So size and liquidity is key, and then free float as well. So these companies have got good free float in terms of shares trading and pipelines as well. Unite is looking at about 7% yield on their new developments going forward. Sheer has got probably high LTV, not much developments. They're focusing more on their balance sheet with the LTV high at about 52%. But occupancy is high, 98, 99%. In 2023, remember, bond yields went up. So asset revaluations probably around plus 1% for Unite, and then minus 1.8 for Sheer. And then rental growth 5.5 to 6%. So when you're listed, it's always important to look at the debt as well. Unite's got a good balance sheet, 28%, and they're still able to deliver positive earnings growth of about 3 to 5%, whereas Sheer, because of their big debt, they're looking at about 0% growth because of high interest costs. So that's kind of things that you have to watch out for when you're looking at some of these companies, and they're paying out about 80% of their earnings to investors as dividends or distributions. In terms of pipeline, as George mentioned earlier on, these are the apartments that you look like in terms of student housing. They look just brilliant. On the left-hand side, that's a greenfield development. Greenfield is basically a new building. They're starting from scratch. That's going to be delivered from in 2026 to 2027 by Unite. That's in London, in Stratford. And then on the right-hand side, that's by Sheer. It's an office conversion. So you're going to see lots of office conversions as well into student housing because of the shortage of apartments and residential across most of Europe and most of these markets. And yields, we mentioned yields of about 6 to 7% across most of these developments. So what amenities are offered by student housing residencies? These are things that you have to look out for, and the most popular one, if you look across most countries, would be a laundry room and your communal kitchen. And then bikes, it depends where you are. If you're in Netherlands or Denmark, then the cycle a lot, you'll find more bike storage. So that's the difference compared to your traditional residential. You don't get all these amenities. So if you're just going for an apartment, you're getting probably keys in the room and nothing else. So you're paying for this and you're getting these benefits. And this is cheaper, probably 10, 15% cheaper than your traditional residential apartments with all these amenities included. So the big thing that's coming up across the world now is green buildings. So there's a big drive towards green buildings. And in Europe or UK, they use what they call EPC, that's the Energy Performance Certificates. And most companies or property companies are looking to get an A or B rating in their portfolios. We can see that with Unite. In 2021, they're 35%, and the portfolio has grown to as much as 92%. So they're more energy efficient, you save more money by having these kind of buildings. And there's also regulation in some of these countries that if you're probably E or if G rated, you can't even let that building. The government don't allow you to do that. So you're forced to have more green buildings. And there's a path to net zero carbon, 2030, 2040, 2050 targets. And these are some of the initiatives that most of these companies are looking at as well, be it electric cars, LED lighting, smart building, and this amazing technology that's going through into these developments. So the big question is, why is supply struggling to meet demand? Let's not forget that you've got, as George mentioned, you've got the living sector. There's other sectors within the living sector that all need to actually grow as well. And student housing is competing with all these other sectors as well. And it's tough to provide that space given the limited land available in most of these markets. And you want to be close to the cities, you want to be close to the campus as well. And with that land, you're competing for other amenities as well, be it parks or recreational facilities, be it shopping as well. So supply of land strictly limited, basically. And also planning requirements in most of these countries. They take time to rezone the land, and also got green initiatives as well, traffic impact assessment, so it takes time. And in markets like UK and Europe, the buildings are, some of them are 500 years old, 400 years old. You can't do much with them as well. So there's limits in terms of how much you can convert or use those buildings, as well as high interest rates. They do affect the viability of some of the projects and high construction costs. But then what is the government doing around this? So they're aware of the problem. It's a big problem everywhere you go in the world. And there's initiatives to offer low interest rates to some of the developers, and then tax credits as well. And is seeing some of the students being offered grants by the government just to help them to top up on their expenses as well, because they pay a lot in terms of student accommodation. And then more office conversions. As we mentioned earlier on, the office market is out of favor. Vacancies are huge. You're going to see more of these conversions from offices to student resi. The last one, it's not a supporting incentive. It's rental caps. In most markets, you don't have rental caps, because once you cap rents, it makes it difficult for developers to build more because they can't get the return. But some of the markets like Ireland, for example, Mike mentioned, they do have rental caps probably between 2 to 3%, but in some of the zones, as well as Sweden, a 2 to 3% rental cap in terms of rental growth. And then markets like France or Netherlands, looking at about 3 to 4%. And then Norway, they cap it in terms of inflation. So there is, but it's still getting growth. But most other markets, there is no cap in rents. So to conclude on student housing, this market is mostly accessible through the unlisted market. There's not many listed players. And I believe there's also room for consolidation in these markets, because there's just so many players across, if you look at UK, Australia as well. And it's a very strong sector with high occupancies, and this is likely to remain for some time. 98, 99% is going to be the number that we're going to see going forward. And supply unlikely to catch up with demand, with even up to 2030, because of the huge growth in student population across markets. And the strong fundamentals, as I mentioned earlier on, yes, there's rental caps in some of the markets, but not most markets as well, because people still need to actually have student housing. And it's more affordable than privately rented accommodation, and very resilient compared to the other asset classes, even in a period where you've seen rates go up quite sharply. And also trades at a discount, maybe because it's not as understood as maybe multifamily residential, but performs much better than multifamily residential in terms of rental growth. And so there is opportunities in that space. And education, most governments everywhere, they're all investing in education and universities, and then it's going to be like that for the next few generations, and that's part of impact investing that we'll see. So it's a very interesting sector, good rental growth prospects, and demand unlikely to match supply, and we believe there's opportunities for the next few years to come. So that's the student housing story. Thank you.
Fantastic. Thank you very much, Keelan. It just reminded me when you showed the amenities that there's no bar there. That's pretty much where we spent all our time when I was a student at RAL. But you talk about the change, George, in student accommodation from those Soviet-style monoliths to what we're offering students today. Very interesting. So let's now segue into a little bit more detail about the business model and how these PBSAs work. And there are too many. These are 4-letter acronyms. We like to say TLAs, 3-letter acronyms in finance, but that's the purpose-built student accommodation market, if you're wondering what the PBSA stands for. And our next speaker is the fund manager for Growthpoint Student REIT, Amor Makumi. He's got 14 years experience in the sector, also in investment banking, equity investments in unlisted sectors across South Africa and the rest of Africa. So a warm round of applause, everyone, for Amor. And I'd just like to remind you, if you do have to leave the room, we are filming, so for all of our online delegates, if you can just duck your head and make your way away from the cameras.
Good morning, everyone. I'm going to look at the sector from a South African perspective. In some instances, I'll use Thrive Student Living as a proxy, just given the lack of publicly available data in the South African sector. So the first question is, what is purpose-built student accommodation? Traditionally, students have been living on campus or privately. So they would either rent a house, a room in a house, or they would rent an apartment. When I went to university 20 years ago, one of the key criteria for the university I attended was being admitted to on-campus accommodation, because my parents were uncomfortable to leave me in someone's house where they're not sure about the setup in that house. Over the last 15 years, there's been an emergence of a new asset class. The asset class has resulted in the private sector, has come from the private sector investing capital and developing purpose-built student accommodation. This accommodation is student-centered. The whole building is catered to the student and their well-being. You'll find that some of the amenities in our properties have laundry facilities, Wi-Fi, which is the oxygen. I think that's probably the most important amenity than a bar. Excellent security. We provide 24/7 security. We've got study rooms. We've got recreational facilities. And some of these recreational facilities vary from property to property and price and product. They can go to the extent of at the upper end of the market where students will have clubhouses and swimming pools. But the majority of the amenities in the market cater for the basic needs of the students. Most importantly, a lot of the players in this market offer a student life program. So that's a program that ensures that students are looked after from a well-being perspective. And that program entails sporting events, academic events, and social events. The South African context is very similar to the international market that Keelan spoke to. There's also a structural undersupply of accommodation in South Africa. That's largely driven by an increase in the number of enrollments in South Africa. So in 2013, we had about 1 million university students, 1 million students enrolled in higher education. And higher education is university and TVET colleges. In 2023, that number is estimated to be about 1.2 million. So last year, the Minister of Higher Education indicated that just for the 2023 academic year, they were expecting 210 first-year entrants into the system. So that shows you the demand for education in this country. The driver for the demand is that education is aspirational. There are a lot of new entrants into the higher education sector. There are students whose parents have never been to university, and they are first-generation university entrants. The unemployment rate for graduates in South Africa is also lower than for people that don't have a higher education. So just by way of example, the Q4 labor survey that's done by the Stats SA says that the unemployment rate for graduates is 9.5% versus the national average of 32%. So people see this and they realize the importance of getting education. It gives you an opportunity to move up the social ladder. Universities globally have not been able to keep up with supply, and there are also barriers to entry on the supply side. Keelan mentioned a lot of them in the UK. Those problems are very similar in South Africa. If you look at Auckland Park, for example, trying to build a student accommodation facility around Auckland Park requires you to buy a few houses, consolidate, rezone, etc. So those are all challenges and barriers to entry that are limiting the supply side. Supportive demographics. South Africa is fortunate to have a young population. So we don't have a lot of international students in South Africa, although the number is significant. But unlike the UK and Australia, the demand comes from within the country. Education is well funded in South Africa. We've got the public sector funding from NSFAS, which you'll hear more about later on. And the private sector is also contributing a lot to funding students. So lots of bursary programs. Parents are also sacrificing a lot to send their kids to university. The sector is resilient, given what I've said earlier on. But what's interesting is that whenever you see students strike, they never strike or destroy accommodation. That's because even student activists know that after a strike, they need to go somewhere to sleep. The returns are more predictable, so you'll find that our rentals rebased annually. That can be viewed as a negative, but we see it as a positive, because unlike other commercial real estate asset classes, where you'll enter into a long-term lease, your escalation is above inflation. After year 3 or 5, your rental comes down, and you've been valuing your asset on the basis of that long-term lease. But there's always a negative reversion to market. These fundamentals have led to capital flowing into the sector. These are the investors that have invested in the sector. They've invested in Thrive Student Living, but also in some of our competitors, the likes of South Point, Rise Student Living, Campus Key. The Public Investment Corporation is probably the largest single investor in the sector. We've got Eskom Pension Fund that are here today. We've got Metropolitan that are also here today. We also have some of the developmental finance institutions, the likes of IFU in Denmark. We've got the IFC, and we've got Proparco. And then we've got the banks and asset managers and endowment funds. So these investors are obviously taking a long-term view. They see the financial return benefits and the social returns. So this is some of the data from our portfolio. We've got occupancies on the left-hand side and rent per bed per month. So on the occupancy side of things, you'll see that we're at 94, 95% in 2018 and 19. And 2020, occupancies came down to 85%. Now that's largely because of the hard lockdown restrictions that were implemented during the COVID-19. Interestingly, in that year, what we found is that the NSFAS-funded students, as soon as the restrictions were eased, they preferred to come back to the purpose-built student accommodation facilities. That is because of the amenities that I mentioned earlier on. University classes were being offered online, but they wanted to study in facilities that had constant Wi-Fi, that had good infrastructure, so that they can have a better education experience. The vacancy in 2020 was largely from the upper end of the market, where students that are from affluent families could study from home because they had the required infrastructure to succeed. NSFAS also continued to pay, so it's always seen as a risk in the sector, but they continue to support the students and pay their landlords and meet their rental obligations. We've seen a recovery in occupancies from 2021 to 2024. It seems like an easy business. It's a very difficult business because it's a consumer-facing business. So a lot of the providers in the space invest a lot of time in marketing and building their brands. So it may seem like demand exceeds supply substantially, so therefore it's easy to reach these occupancies. But it's actually a very labor-intensive business. Reaching these occupancies is not just a given. On the rental side, we've seen rental growth until 2023. In 2023, we saw rentals coming down, and that was largely driven by the NSFAS cap for student accommodation allowance. That cap impacted certain universities. So in 2023, NSFAS made an announcement to say that the student accommodation allowance would be 45,000. It didn't have an impact across the country. The universities that were impacted are the ones that are largely located in metropolitan areas. The benefit of having a diversified portfolio from either from a product type or from a geographical location is that for our portfolio, we just saw a -3% reduction in rentals. So diversification is key. Investors always look for diversification, but it's important to look at geographical diversification and also product type. So there are some players that only cater to the upper end of the market, and there are others that cater to a broad segment of the market. PVSA is no different to the rest of South Africa, either individual consumers or real estate companies. We've seen operating costs increase substantially, and this is largely driven by the above inflation increases in administered costs, the likes of rates and taxes, water, electricity. 2023, we had the highest levels of load shedding, so that also impacted our operations. We've got generators in our properties. You have to obviously fuel these generators with diesel to make sure that the students can have electricity in order for them to study. And the generators are not designed to operate at stage 6 load shedding, level 6 load shedding levels. So that equipment also fails. So we've seen that trend where costs are increasing because of largely things that are out of the control of the operators in the sector. 2024, our forecast is that costs will increase again. We're fortunate that so far the load shedding has been lower than last year, but we're being conservative in that forecast. We still think that load shedding will come back. Cost to income ratio was consistent until 2023. Rentals came down, costs increased, and that's why you see the increase in the cost to income ratio. 2025, that's almost flat. So although our cost per bed increased, we estimate it will increase by 12% between 2023 and 24, our cost to income ratio is stabilizing. And that's because of the asset management initiatives that we've implemented in our portfolio. We expect that to decrease further over time as we begin to install the solar panels in our properties, getting boreholes, and making sure that the infrastructure that we are building into our property will result in a reduction in the operating costs. Again, this is where the differentiator between institutionalized players will come into the informal sector. Not that the informal sector is bad, but as the sector attracts capital and gets institutionalized, there are initiatives that can be implemented in these properties to reduce costs and ultimately give the students a better experience and better value for money. Investing for impact. A lot of investors want to see impact in addition to financial returns. These are some of the SDGs that we are targeting. You've got good health and well-being. Our student life program caters to the students' well-being, and not just Thrive Student Living student life program. I think a lot of the operators in the market have a student life program. So you've got good health and well-being where students are given academic support, they are sponsored to participate in sporting leagues. That's to keep them active. It's better to be in a purpose-built student accommodation property from a well-being perspective than just living in someone's apartment. Quality education, good accommodation within close proximity to university improves the likelihood of you passing because you're part of the university community, you've got the support that you need, and you are more likely to pass than if you are in accommodation that is of a poor standard. Gender equality, you'll see that the graph on the bottom right, in our portfolio, we've got 67% females, 33% males. That stat is in line with university enrollments and just the national statistics. Decent work and economic growth, George spoke to it earlier on. The sector has invested a lot in this country, and we continue to invest capital and make sure that we preserve jobs and increase new jobs. Reduced inequalities are obviously a result of quality education. And sustainable cities and communities, we cater to different parts of the market. 50% of our students are NSFAS funded in our portfolio, the other 50% are privately funded. So for us, sustainability is having facilities where it doesn't matter from which walk of life you come from, you can be accommodated, whether you are NSFAS funded or you are privately funded, either in the same property or in the same portfolio. And I think that's the case with many of the institutionalized players in the market. Thank you.
Fantastic, Amal, thank you very much. That last slide was quite interesting. Maybe I'm the only one, but I had a misconception that the weighting towards NSFAS would have been higher. So I think it's quite interesting because often when we look at what's going on with NSFAS and we think, oh, it impacts the entire sector, it's not necessarily the case. But I don't want to preempt myself. I think we're really going to get stuck into that in the panel. And what I'd like to remind our audience as well is to keep those questions coming, because we're going to have a 15-minute Q&A at the end of the panel, online as well. You can type those questions for the panelists right at the end. We'll take those at around 11:45. But firstly, I'd like to invite our panelists up onto stage one by one. Firstly, we've got Motlatsi Motlanyani, who's Head of Alternative Investments at Momentum Investments. He joined Momentum in 2008 as a PM to focus on LDI, liability-driven investment mandates, and customized solutions. Do we need an extra? I'm going to shift across here. There we go. And he's head of Momentum Alternatives, so he's responsible for things like private equity and unlisted property and things like that. So a warm round of applause, everyone, for Motlatsi. Then we've jan Daniel Klopper, who's head of manager research at Mentonova, with 7 years experience specializing in investment consulting and multi-management. Jan Daniel has led Mentonova's manager research team for the last 2 years, a UP graduate, so he's also got his experience in the student accommodation space, I'm sure, with the BCom in investment management. He also serves on the IC, overseeing 250 billion rands worth of assets and clients, including pension funds, medical aid schemes, trusts, and direct investors as well. Jan Daniel, thank you for joining us. Then we've got Lerato Nake, who's the Chief Executive and Technical Director of Kia Capital, who's got some great insights into the NSFAS ecosystem. He's got over 13 years of executive management expertise. He was previously the chairman of City Power, so I'll try and steer clear of too many local government issues for now, because there's so much to unpack in that space, Lerato. But he was also the CFO at NSFAS, and so has some deep insights and rich insights into what is going on at NSFAS. And I think, you know, the one thing about NSFAS, and I know there's been a lot of negative publicity, but it's one of those institutions that if you look at how important education is to the country, it is almost too big to fail. And one gets a sense that we're starting to see a real rallying of support around, you know, how do we fix NSFAS, or how do we make sure that it's fit for purpose, given that we all have to deal with that surprise of free education. That was one of the legacies of former President Zuma. And then lastly, but certainly not least, is the rose amongst the thorns on our panel today, Sepaiti Moichela, who's a portfolio manager for real assets at Eskom Pension and Provident Fund, and has got almost 2 decades experience in the financial sector, banking, asset management, including DFIs as well. And we saw DFIs, big investors into the space. And her journey commenced in the banking sector, where she trained for her articles with ABSA, and post her articles took up a role in corporate credit at that bank and later with Nedbank, and also has mastered credit risk analysis, and has also got experience with the DBSA as well. So Sepaiti, thank you very much. Warm round of applause, everyone, for our panelists. And I thought it would be fitting to start off with this quote from Madiba, who, and it's one of the great quotes, I think, and he was very passionate about education, saying that it's this great engine of personal development, and it's only through education that the daughter of a peasant can become a doctor, that the son of a mine worker can actually become the CEO of that mine, and, you know, the child of a farm worker can become the president of our great nation. And on that point, Lerato, maybe you can just kick us off, because the elephant in the room is... oh, do you need the clicker?
Yeah.
Oh, you're going to take us through a presentation as well. I thought I was just going to grill you. No. Take us through what's going on at NSFAS, because everyone's been talking about the cap. It took a lot of people, investors included, off guard. With your experience, talk us through where NSFAS finds itself, and how we fix NSFAS and make sure that it's part of the solution and not part of the problem.
Yeah, sure. Thanks, Mike. Morning to attendees, both online and physically. Let's get one thing clear. NSFAS is here to stay. It's a government policy, and if you look at what government looks at, before we even get to NSFAS, I mean, if you look at the grant system, there'll always be people being born, being funded, going to school, graduating, going to university. So there's a growing number of students that are going into university in terms of enrollment, and DHEAD also focuses on enrollment. So government, when they sit, they build a policy or they create a policy, they look at two things in the main: students who are coming to university, students who are exiting the university. And that number remains there. So we are nearing politics or the elections, as it were. Now one might ask that, what if there's a new coalition coming in? NSFAS funds for a course of study. In other words, you come in, you do a BSc degree in electrical engineering or whatever. That is 4-year degree plus 1 year. So that is 5 years. So if you are invested now, it doesn't matter who comes in tomorrow. Those students are already in the system, right? So the money that you're going to put in tomorrow, or the money that you've already invested, it is safe. Those students are there. And now, if you look at the fact that this investment, this purpose-built student accommodation, operates in a secular environment or secular business model. In other words, you create value, you deliver that value, you capture that value, minimizing cost to society. It means that what Growthpoint Investment Partners and other guys are doing, they're ensuring that these students are safe. But they're also equally assisting the government to do throughput or to increase throughput of students. Because you can eat, you can study, if you don't have a safe environment where you're going to be able to study and write your exams, it's futile. And most importantly, when we were looking at the numbers in 2018-19, when fee-free education came in, over the MTF period, government was going to put in the 56 billion rand. Now that's a lot of money. That's a lot of money where government can't just stand and allow NSFAS to fail. There's NSFAS, the entity, that it has many challenges, as we know, but then there's the NSFAS in terms of the policy and what government wants to do with it. I mean, if over 3 years to 2020, you're putting that much amount of money, and that money was split between the TVET accommodation, the allowances for TVET students, the infrastructure for universities, and the student funding for students. And one of the things that are appealing about this investment is that if you go to university today, government funds you, you're a student, government funds the university for that student. So when a student fails, it's actually quite expensive, because for the following year, government does not give that university money. So the student purpose-built accommodation assists with that throughput. And it's an impact because it guarantees the safety of students, as we know that some of the campuses are not safe. But in that ecosystem, there's also limiting factors, as we know. We are dealing with a finite pot. When fee-free education was announced, it was announced. National Treasury had to reprioritize the funds from other pressing needs of government to students. And also the students the scheme just grew from fee-free education. You used to find a certain number of students, suddenly you find yourself with 600,000 students that you need to fund. So when we look at the rental cap, why NSFAS introduces the cap, the best way to deal with it, in our professional view, is to ensure that there's policy certainty. We avoid situations where in 2022 it was 60,000, then it was just unilaterally reduced to 45,000. Our view, the scheme is too big to just be left to public sector alone. All the role players, including this asset, they need to come into the party. They need to be allowed to come into the party. But we also need some assurances, like for example, there's been a change of guard now, government has intervened because there were challenges in the system. But with the administrator, we need written assurances. You know, the PBSH need to come in, sit with USAF, University of South Africa, need to sit with DHEAD, so that we can agree that if there's going to be a material policy change, all the stakeholders will be consulted first. So we're not going to sit, the private sector has invested money, and remember government deals with two things, Mike, just to recap, is the enrollment and the throughput. And you're assisting with the throughput to limit the cost. So it cannot be that you play such an important role, then you get left out. Then you find out after the fact that, no, oops, we've changed the policy. So going back to your question, the scheme is important. The scheme deals with human beings because there'll always be students coming in. It's not like we are manufacturing devices like these ones, where at some point nobody will need them. There'll always be students who are coming in. Just to conclude on your question, the NSFAS student is not a first-year student. He's a grade 11 pupil. And if you look at the grant funding that government gives in terms of SASA, those are the students that are 350 and below. It's a captured market. So when NSFAS does its target on its own, at least back then when we were there, would look at the grade 11 student, then go to grade 12, then we know that in terms of the first-time entrance or first-time equivalent, as it were, this market is captured. Then there's also an opportunity here in terms of the missing middle. Government has just put in 3.8 billion rent, as the minister announced. There's an opportunity to have different rental pricing. Again, we are dealing with a finite pot, right?
Just one more follow-up before we go to the rest of the panelists. I completely understand that it is systemically important from a policy perspective, and so, you know, it would be government's prerogative and priority not to let it fail. And so we've seen the intervention. We've now got the administrator in Freeman and Valo. He did a great job at SAICA. I did note with some interest, though, comments he made a couple of days ago that everything will be fixed by the end of May. It seems to be a very complex issue. We're talking about IT systems. You know, how realistic is a quick fix for NSFAS?
I need to be careful in how I respond to this one. I think we need to split the challenge that NSFAS is facing both at government level and the broader sector, the PSET sector, the PBSA, and the entity itself. And there are short-term measures that we can put in place. There was supposed to be a user group that was USAF was pushing last year, August 2023. That did not materialize for one reason or the other. That needs to be resuscitated, right? As I've mentioned, NSFAS is too big. It's just too big to just be allowed to run on its own. There needs to be a memorandum of agreement between the PSH, the administrator, and NSFAS, so that we can agree on key policy items, and we can also have an honest discussion, right? To say, here's a laundry of issues from NSFAS, the entity. Here's laundry of issues a list of issues from a policy perspective. And then PSH can go and register with BUSA. BUSA can take those issues to NETLEC. NETLEC can take those issues to government. Then government can take it to parliament. So we don't have a situation of NHR where everybody says, but I wasn't consultant, because this thing is just too big. Because at the end of the day, we are dealing with human beings. So there's kind of issues that are put in here. There's definitely technical assistance. I mean, having been there from 2013 to 2018, when fee-free education was announced, it was in December 2017. It was supposed to be implemented in 2018. Now, NSFAS used to run a bursary scheme and a loan scheme. You can't just change the systems overnight. It was 500,000 students then, and you have 4 ports. So to run transactions of around 2 billion on a monthly basis. So I think that the administrator, I don't know what informed this view, but he can't do it alone.
Yeah.
Everybody needs to come to the table, and there is a solution. The private sector has the solution, because NSFAS is also now being asked to be a property manager when it's a financial institution. And if you take those things and you say, private sector, PBSA, you guys have the capacity to do the administration insofar of allocating the students, billing and everything, let's come to the party. The university also has a role to play, because the landscape that the administrator is facing is 26 universities, 26 CFOs, 26 VCs, 26 registrars, maybe 52 financial aid officers. You've got 52 TVET colleges. So realistically, the issues can be dealt with this year, but my professional view, end of May, it's a bit. Let's come up with realistic timelines so that we don't kill the confidence in the sector. Because now everybody's looking at the end of May, it doesn't happen, then what now? Right? Because
Absolutely.
it's a beast. I've already told you about 2 billion transactions that have to go through on a monthly basis. So it's not a small shop.
Yeah. And I think on that point, just to stop you there, because I think you've made the point quite succinctly, we shouldn't be over-promising and under-delivering, and we shouldn't be ignoring the size and enormity and complexity of the task at hand. And it certainly doesn't feel like something that can be fixed just in a couple of weeks. But at least we're now having the conversation out in the open, and I think that gives me great encouragement. Matlati, I just want to move on from an investment perspective, and really what informed your investment committee meeting when you were sitting and deliberating on allocating capital to this particular specialized, almost niche area within the property asset class. What informed that decision? Maybe you can just take us through the thinking process.
Yeah. So we run infrastructure portfolios, and in particular, we look at 3 sleeves of that. So we look at the energy sector, social infrastructure, and core infrastructure. So within the social infrastructure, I mean, George just mentioned this, that in the social infrastructure, you got things obviously like student accommodation, affordable housing, data centers, so quite a few things that fall under there. And we've identified that as an impact investor, there are 2 specific areas within the social infrastructure where we can make the greatest impacts, right? And that is student accommodation and affordable housing, right? So, and student accommodation in particular, what's motivated us to go into that is that the fundamentals are obviously a very strong fundamental. So looking at a macro level, we know, for instance, that there's a massive funding gap there. That's really underpinned by the supply-demand dynamics within that space, right? So, I mean, we don't need to go into the numbers, but everybody has a good idea of the kind of demand that's in there. That I think in 2022, we had, I think, about 225,000 beds in supply now, whereas in fact, the total need is closer to 510,000 across universities and colleges, right? So if a single bed is costing, call it 225,000, 230,000, I mean, that means that we have over 110 billion of financial shortage that's to supply there. So from that perspective, it makes it a lot easier than to focus on that sector in particular to do that. And talking about fundamentals, I mean, we also know that we've got a young population, and especially a particular need within the affordable space sector, in the accommodation space. That's where most of the need is. We know also, as discussed earlier, that universities are not building new facilities in this. They're looking more at the private sector to provide accommodation in this space. We know also that it's a very resilient asset class. I mean, we've seen the numbers there. We know that during COVID, relative to, I guess, the commercial property, student accommodation was able to hold its own relatively well. So that's obviously very encouraging from an IC perspective, investment committee perspective. Those are the kind of things that we look at. We know also that it's got very stable returns. For instance, capital value appreciation and obviously rental resets are obviously comforting from a return, from stability of return. And that's only at a macro level. And then when we look at each investment, specific investment, the kind of things that we'll be looking at, for instance, we look at the yield. We'll look at, okay, maybe I should step back a bit. From our perspective, we'll look at obviously the financial side of it, so the return side of it, and we'll also look at the impact side. So in the return space, we're looking at the yield, we're looking at occupancy. Our requirement in general are that we're looking at a minimum of 95%, or at least projected occupancy of at least 95% in the facility. We'll look at obviously the inflation linkages of how increases are factored in, particularly from a private occupation, not NSFAS in particular. And then on the impact side, we look at quite a few things. Obviously, affordability is a massive consideration for us, right? We'd look also at something that you mentioned earlier on about the NSFAS price point, right? So we're looking at anywhere between 45% to 75%, depending obviously on location for NSFAS point. Obviously, this is kind of dynamic now, given everything that's happening with NSFAS. But that's generally the range that we're looking at, right? We look also at locations, so we'll grade the different universities differently. So whether it's in the major nodes, Pretoria, Joburg, Cape Town CBD, relative to outside of those nodes. So KZN, for instance, Eastern Cape, Northwest, and Northern Cape, so around the Kimberley area. So depending on those, we'll give them a different rating from an impact perspective. And then the other kind of things that we look at a secondary level is the number of beds that we're providing in each area relative to the actual demand in that area. So we'll get people to actually work out for us what the demand is in that area. And are we providing 500 beds? Are we providing 1,000 beds? And all of that effectively comes to a score that our investment committee will then look at and make a decision then based on that.
Very interesting on that last point. Is there an impact risk trade-off that you might go through to say, right, in a particular area, maybe outside of a metro, we might have greater impact, but there might be slightly higher risk, and then do you kind of try and trade them off against each other when you go through that component?
Yeah, I mean, it's inevitable that you're going to have to weigh one more than the other at certain points. But I mean, to give you an idea, we're looking at, because this is equity investment, we're looking at IRR's investment return of anywhere from 13 to 17%, right? In a good environment, you'd expect around 17%, but I mean, we understand the dynamics of this sector. So from an investment perspective, that's the kind of return range that we're looking at. And then we balance that off then with the other things that I mentioned, the scoring that we give, which are not obviously always can be scientifically measured, but we try as much as we can to score them based on obviously on a criterion. And then we add those together. And then depending on where that comes out then in our matrix, that's where the decision then gets made.
Yeah,
so we try not to trade off. We try to obviously complement each one with the other. But in some instances, like for instance, to give you an example, in Northern Cape, for instance, if we're looking at a Kimberley development, the financial return there obviously is going to be at the lower end of the scale, right? I mean, I know that other people will say because you're taking greater risk, you'd expect greater return. But in reality, it won't work like that, right? You'll probably prioritize more the NSFAS point that you're paying at, and obviously that will be at a higher point, because you don't expect students at that level to top up or to have a lot more private students as you would in like a Hatfield environment, right? So those kind of dynamics have to, I mean, you have to be realistic about which one is a priority, which one do you actually, are you being driven in this instance by an impact imperative, or are you being driven by a return imperative? And that's the kind of decision that an IC would have to make. I think we found quite a comfortable point in our IC about which area we want to focus in. So we in the Cape Town space, for instance, which we know that it's a well-developed market. There's relatively good supply. It's obviously not as good as, let's say, for instance, Pretoria, which is becoming a lot saturated in terms of private supply. So in Cape Town, you know that there's still quite a lot runway in terms of your ask that you can put to students coming in. So that's actually quite good. So that's a comfortable location. And then we can balance it off at a portfolio level with a lower return expectation from other areas such as KZN, for instance, or Eastern Cape, or even Northern Cape, as I mentioned.
That's quite interesting because you speak about a portfolio approach even within the student accommodation subsector. So it shows you, Jan Daniel, to bring you in, how granular one can get in approaching this sector. What motivated your advice to invest in the sector to your clients?
Yeah, so just to take it sequentially and start at the beginning of how we give advice, is we optimize for strategic asset allocation that is capable of achieving the highest probability of achieving a certain CPI plus target. So in order to do that modeling, we make use of the listed asset classes to construct a strategic asset allocation. So the opportunity arose with the increased allowance from a Regulation 28 perspective, where most of our clients are, Regulation 28 constrained investors. So ultimately allocating to local alternatives. One, it causes a issue where we don't necessarily have the long-running data which is available on the listed counterparts. That being said, though, the unlisted allocations we allocate within infrastructure broadly competes against those listed counterparts. So to the question you posed to Mutlatsi on whether there's an impact versus commercial trade-off, it's firstly the commercial needs to stack up with the added qualitative consideration. So what drew us to alternatives is one, the regulatory changes, and then secondly, and more specifically to the unlisted property infrastructure allocation, is one, there is again, to Mutlatsi's point, a demand-supply imbalance. There's opportunity within that. But we also see that as an allocation within the sleeve of unlisted property allocation. Again, not to resonate too much with Mutlatsi, but it's only one part of an allocation within the unlisted property allocation, alongside social infrastructure, affordable housing, but then also rural retail, underserved retail opportunities. So it's ultimately identifying the opportunity in the unlisted market, where underserved market, and ultimately delivering an impact within that market, touching on the various SDGs, focusing on quality education, economic growth, sustainable communities and accommodation, and then also equality for 8, 10 and 11.
Well, and I can imagine with Regulation 28 and allocating more to alternatives, but also increasing the offshore limit to 45%. That's been a big concern for asset managers investing into local opportunities. And one would hope that, and we have seen, if you look at the Alex Forbes Manager Watch survey, a rush almost to the exits over the last 12 months, but now kind of leveling out, that we'll see a reevaluation of local allocation opportunities. So, Pati, I just want to bring you in here from the Eskom Pension and Provident Fund perspective. So now, as a fund, one of the largest supporters I know of private equity and unlisted and alternatives, how did you approach your IC committee meeting when the opportunity arose to invest in student accommodation?
Yeah, I think my peers here have given you all the points that any investment committee that has a mandate to invest in private markets would consider. But specifically for EPPF is that we have a mandate, long-standing mandate of investing in infrastructure long before it became a Reg 28 issue, a government issue. We've had that mandate to invest in infrastructure, both social infrastructure and economic infrastructure. And this is an opportunity that fell squarely in the social infrastructure space. But then the headwinds, if you look at the headwinds in this sector, it's not so nascent in the South African space. It's emerging, but not so nascent. If you look at the 2011 ministerial review reports, it went out to review the landscape of student accommodation across South Africa for all university and TVETs, and the situation was very dire. Students were living in tin shacks, in backyard rooms. Amo alluded to that. So the demand for a decent, dignified student accommodation has been there. We have the gap of about, over 500,000, 620 beds, and it's growing because each year the number of students enrolling is increasing, and the supply is not catching up as quick as it should. So there is a demand factor to this that provides the headwinds. There is a return factor. So first and foremost, we invest for a return. Our members want to be paid. So their retirement, and it has to be a payout that increases at the CPI plus. So the performance of the sector over the years has been quite good, even though it's not so well mapped and so well documented, but it's a sector that we've been eyeing for the longest time, and we've been mapping out its performance. You would see that this platform offers us a yield that is very competitive. Let me not mention it in number, in a digit, but the returns that you can get in here are very competitive to your normal, commercial and logistics asset, the REIT type of investments. So that was very key, that financially the opportunity stacked up. It will give you that annual, annuity, and it's very much predictable because the sector is very defensive. It's resilient. The students will always be there. NSFAS has paid out through COVID. Even before COVID, there have been administrative challenges, but by and large, no manager or no vendor would say has never been paid. They may be paid late, but they have been paid. So, payments have been there, and the returns have been good. And we are lastly an investor of impact, or investor for impact, positive impact. We have our own SDGs that we target, among them economic growth, reducing inequalities. And what we liked about this platform and many other opportunities that have come our way is that you have a product that is not necessarily differentiated between an NSFAS student and an out-of-pocket student. That on its own, yes, you reduce inequality because NSFAS is there to fund education. You have, facilities that are in close proximity to the universities. They are structured in a manner that makes the learning and the student experience wholesome. But the inequality, it's more on also, one of the factors is that we don't want the situation that perpetuates inequality in a sense that a poor student gets a lesser facility because they don't have the means to come in versus that student who's got the means to take care of themselves. And these facilities offer exactly that. When we talk of reducing inequality, you have those facilities that are standardized, and equality means same, you tweak and you adapt the process and the systems and the offering to make things equal. So you take that student that has no means to come into this decent facility with all these amenities they need. You bring them at an affordable price compared to that one who has the means to get there. So it was impact that we were pursuing with this opportunity. It is good competitive returns that we pursued with this opportunity. And
I want to stop you on the point of returns, because I know you said you don't want to share what those returns were, but maybe you could take us through your thought process as to why this asset class and not bonds, for example. If you look at the SA 10-year, gives you CPI plus 5.5, 10, CPI plus 6. It's at 10, 11%. It's been over the last few years. Why allocate to this and not something that appears to be slightly less risky?
So it's not like, with the SA, with the strategy asset allocation, you allocate funds to all the pockets. But when you then look at the returns, you say, over and above the financial return, what else am I achieving with this? And that was the impact. If you look at the returns, why would we not? We do invest in a bond, but we go further and we say, this asset, Motlatsi has mentioned, it will give you an IRR of between 13% and 17% over a period, over a 7-8 year period. But there's a yield component in how this platform on its own is structured. There's a cash yield that you will get on an annual basis, which we need because we have liabilities that we need to service on an annual basis as a pension fund. So we do want that cash yield, which compares very competitively with a REIT or even really, a fixed income instrument. And I mean, for this platform, now you're pushing me to go to that figure. But it was really giving a competitive yield of between 8% and 10%. So you diversifying your portfolio. You can get less risk elsewhere, but you're not totally exposing yourself to a loss situation, and we can discuss risk and risk issues and mitigating why, even though this may appear to be much riskier than a fixed income, it's still a worthwhile investment.
Yeah, I like that. And maybe we can also just understand, Motlatsi, how it's performed versus other investments that you've made, because there are a few questions coming through from our online audience as well, similar themes around the fact that, and George mentioned it earlier, property as a bucket has been a swear word for the last few years. So how is this particular niche part of the property portfolio performed versus the rest of your investments?
All right. Well, I can't talk about the listed space because that's not where I focus. So we focus very much in unlisted. So when we look at this almost as a private equity investment, right? That's our approach to it. It's in private markets, it's unlisted, and that's how it fits in. Now, we are still invested in the space. So that either means that the asset is performing exactly as we expected, or forward-looking, we expect it to perform on par with private market returns. So if you look at what private equity generally generates, right? Private equity would generate anywhere from 18% upwards, maybe up to about, say, 25 in a really good year. We are looking at this asset, as I said, anywhere from about 13% IRRs upwards, right? You'll excuse me if I talk in IRR terms rather than in yield terms, simply because, as I said, we look at this as a private equity investment. So if we are earning, let's say, 15% on this asset, and then additionally getting all of those impact things that we're looking at, that for us is exactly the space that we want to be in. So it's exactly in the slot that we're looking at. So this asset, relative to bonds, if you look at it over, let's say, a private equity term, which is anywhere from 10 years to about 12 years, where bonds are yielding about 11% nominal, it's exactly in that spot and actually are outperforming that. So you can actually look at this as just below your equity performance. So either as a MES instrument or some kind of hybrid instrument that you're investing in. That's a kind of, I think, a comparable that we look at this, alongside. And in terms of, is it performing or are we expecting it to perform within that space from 15% and above? That's exactly what the asset has been doing. So we've been in this space now since, specifically investing in PBSA since about 2019. So we've had at least some 5 years odd of performance and tracking how it's going and looking forward on both local, other local investors and also internationally on what's happened. So we've studied the Canadian model, we've looked at the UK, we've looked at Europe and specifically in France. We've looked at Malaysia and we've also looked at Australia. And so far the dynamics are exactly the same as what we've seen there. And those assets, we've seen what their performance is in, and we're exactly tracking in relative terms, in par terms, with what that's doing. So we're quite comfortable with where the asset is performing.
It's very interesting to hear that we are tracking along with our global peers. Jan Daniel, would you increase your allocation?
It depends.
Ah,
So
no economists on the panel, please.
yeah, so ultimately it comes down allocation to infrastructure, and within infrastructure to social infrastructure. It depends on. Mutlatsi mentioned they've been active in the space since 2019. What's it? And a few, I might be mistaken, Growthpoint Investment Partners has been active since 2020. So to take a conservative approach, we see a allocation toward infrastructure as a whole, pragmatically 5% at this point, competing for the same allocation with the listed counterparts, which I alluded to earlier. And the more data we get that becomes available to us, we would reassess to see other or higher allocations possibly in the future. That being said, compared to our developed market peers and also some, let's call it leading emerging markets, South Africa is far behind those peers in infrastructure unlisted allocations. So is there opportunity in the future? Yes, there is, especially with the increased allocation from a institutional point of view. And as we see more institutional players coming to the party and creating liquidity within the asset class, one could expect increased allocations. At this point, though, we're comfortable sitting where we are. And it's one needs to consider the wider environment as well to avoid excessive exposure to a single sector and towards a single instrument within that allocation. So it is definitely dependent on the opportunity set that is available to us. We are sector agnostic, and in our approach to alternatives allocations, we do focus on a few SDGs which we want to target, but to allude to some things Sapati mentioned a bit earlier in our prior conversations today, is we're not going to preclude ourselves from allocating to opportunities as something in the medical space, medical and well-being opens up. So it is dependent on the wider opportunity set as well, if we would see ourselves increasing the allocation, but then also the data as we are join this journey in the asset class and see how that institutionalizes.
I've got to ask you, and I'm going to ask you the same thing, Sapati, to give you a bit of time to think about this as well. Given the issue with NSFAS, how does that factor into your decision-making process when you weigh up the risk and reward?
Yeah, so NSFAS is it's a well-publicized risk. So not to use the only one free lunch in investments, which is diversification, but to focus exactly on that is firstly to focus on universities that are diversified in terms of location, and within that trying to partner with best of breed managers, leading managers that have the skill to identify these projects around these universities, and universities that are financially stable and administratively capable. Those are some of the considerations when dealing and thinking about NSFAS. That being said, to avoid a complete exposure to NSFAS is something Sapati also mentioned earlier, is mentioning the various socioeconomic groups that participate within the accommodation space around universities. That being said, to avoid overexposure from a financial point of view to NSFAS, to include students that are funded, privately funded, bursary funded, but then also publicly funded. So from a funding point of view, and also a diversity in terms of graduate level, undergrad, postgraduate, and medical, and ultimately focusing on the throughput, which was also mentioned a bit earlier.
But Sapati, and coming back to what you said earlier, one has to be mindful as well that you don't want to be deepening inequality in a space where there's such need for access to quality accommodation and the facilities that come with that. How concerned are you around the NSFAS risk that is present, and how do you go about evaluating that in your investment decision-making process?
Great. We understand the role of NSFAS in the student funding for education. We're very comfortable with that role it plays and comfortable with the policy position around NSFAS. So while there are administrative issues in NSFAS and all the issues going through, on in NSFAS in administering the schemes, we think the biggest anchor and comfort for us comes from the policy position that the government has taken in funding higher education. If I take you back to the NDP, and I mentioned two things from the NDP, it would support universal access to education, from early childhood education right up to higher education. And government made a commitment through NDP that it will fund higher education, because to give access to a student that is from a disadvantaged background without financial support, it's as good as not giving any access, really an opportunity to those kind of students. So there's a very strong commitment from the government, it's through policy, that it will always make funds available to NSFAS to make sure that the poorest of the poor have access, and a meaningful access that is supported with funding. So we do not see the risk to NSFAS as, very, strong. It's there. There are concerns around how it's administering, but we think that government will always stand behind NSFAS in terms of making funds available. So to us, that really is an offtake. It's it's an undocumented offtake that any student that qualifies for NSFAS shall be provided with the requisite funding. It will be great for NSFAS to really resolve their internal issues and put up systems and processes that makes it efficient, and they are able to deliver that funding to students and to vendors on time and in the time that it is allocated in the right amount. But we do not think that a fund like NSFAS, which funds almost 50% of the enrolled students around universities, will all of a sudden tomorrow, not be there, regardless of who governs this country. We have seen what happened with the, fees must fall.
Yeah.
And I don't think any government that comes into power would want to risk a repeat of a fees must fall.
Classic FM was in Braamfontein and DeCorter Street during Fees Must Fall, and that risk I think creates a lot of political incentive as well to ensure that the problem is sorted. Just as we wrap up, and there's some great questions that have been coming through on the platform, so thank you very much for those. But I think we're going to have to take many of them offline, as they say, to the trip to Braam if you're going there. I just want each of you, and Lorata, maybe you can kick us off, just to give us a brief final thought on kind of the future of student housing in South Africa, and maybe one key takeaway that you'd like our audience to leave with today.
All right, cool. Thanks, Mark. Firstly, if you look at the scheme, right, it's just too important a program for government to just let it fail. Because at the end of the day, we are dealing with human beings. There's live people there. So the PBSA as an asset class, there's an impact there. The throughput, having been student myself, and maybe just to break the NSFAS student cohort, you've got what we call the first-time entrants, meaning grade 12 to first year. Then you have what we call first-time equivalent. In other words, you went in 2022, you didn't do well. 2023, you're not studying, you're coming back in 2024. Then there's the returning students. So there'll always be students going into the system. And my view is that this scheme, this program, there's so much amount of money being put into it. The private sector need to be given space to come in. These issues needs to be discussed at the right policy level, at the right government level. I've already mentioned Busa. And then this needs to be treated like George was saying, the beginning of 2005 when the REIT started, because now it's a new asset class. All of us needs to go back to National Treasury, but with a clear position paper to say we've created this asset class. This is how much it is worth. This is how much we want to invest in this asset class. We now need some form of breaks so that when eventually released, we don't wake up and then we are left to an entity deciding on its own that we will increase the rental by this much or we'll reduce it by this much. It is actually a well-regulated, well-run system. So for me, it's the short term. Everybody must come to the table. We must have an honest, open conversation about the challenges that we are facing, of which I believe they're not insurmountable. We need to allow government to deal with policy. We need to allow NSFAS to administer the scheme. We need to take parts of the function that do not belong to a national financial aid scheme to be given to guys who are competent to operate. In this instance, the PBSA, they operate in the housing or student accommodation. They need to be given a space to bring in their expertise. We need to agree on policy. I think if you're going to put in 3.5 billion like Growthpoint Investment Partners have already done, and the other guys who already invested, policy certainty is very important. And we need to co-create that policy instead of just yelling at each other. Yelling does not help. You know, it's like the kettle is calling the pot black. It doesn't help. We need to bring everybody together. And in my view, what I like about this, if I look at myself when I started, where I stayed, versus where students are staying now, it's much, much safer. You know, it just provides that safety for females at universities and also males.
Yep.
So it is quite an important asset class.
And to the earlier point, I think Amal raised in his presentation, and it comes through in the unemployment, the quarterly labor force survey, you know, the higher levels of education you attain, the less likely you are to be or find yourself unemployed.
Yeah.
So it's probably the single most important lever that we have as a society to tackle our systemic unemployment crisis. And I think that can galvanize everyone. Jan Daniel, what would your final thoughts be, and what would you like to leave the audience with today?
Yeah, I think it's to avoid the first layer and focus on the second order discussion, not necessarily just focus on what's being perpetuated, headline grabbing news and such. I think there's loads of opportunities. Education is a great equalizer. It brings hope, and for so many people to attain a higher lifestyle. And through focusing on student accommodation, firstly, I think there's opportunity from a commercial point of view, especially considering the negative sentiment around the asset class. I think there are definitely select opportunities within that. And that's ultimately a great benefit to the individuals benefiting from this infrastructure. It's a benefit to each and every pension fund investor that wants to retire in a better South Africa one day, while also seeing the retirement funds grow for them to participate in that better future.
Yeah, absolutely. Matlatsi, I'm going to leave Sapati with the final word, so you get the penultimate word.
Okay. I guess, I mean, if you're a trustee or if you're a potential investor in this space, my parting words to you, or at least my bit of tips or guidance would be, I mean, think of it this way, right? Enrollment rates in universities and colleges are increasing, right? I think 3 years ago it was about 3.5% rates per annum. I'm sure it's much higher now. So we know for a fact that this space, the supply-demand dynamics are going to be with us for a long time, right? So there's that. And secondly, related to that is that participation rates in the higher education space are increasing. South Africa is still relatively low compared to comparable countries in the same socioeconomic environment. Mm-hmm. So that's increasing, which is also, as an investor, quite an encouraging thing. And then thirdly, particularly around this whole NSFAS thing, I think we have to take comfort in the fact that there's broad agreement and alignment between all the stakeholders within this space. So between Department of Higher Education, universities, private providers, PSPA, around where the industry is going, whether it's around how accreditation goes, the criterion that's used for that. I think there's broad alignment. It's just, the implementation, or at least how NSFAS is being implemented, that still needs to be resolved. That's why, like Sipati, we're not that concerned about the current noise in the system, because we think that it will be resolved. And I think, for most of us, we can take comfort in that alignment. And then lastly, this is a resilient asset class. It's proven itself thoroughly. You just have to look at, what Amos spoke about earlier, about what's happening in other environments, and what Keelan discussed with us also about, experience from overseas, to see that this asset class actually, the investment case is a very strong investment case. And if you follow it up and compare it with other asset classes with more or less similar dynamics, or with more or less the same kind of return target, it actually holds itself very well in that.
Well, I think any asset class that can withstand COVID, ESCOM, and everything else that we've done in it and still be resilient can only mean that when things start improving on the macro level, imagine when rates start coming down. So, Pati, I want to give you the last word. My grandfather's advice to me before I got married was always give her the last word.
And she's always correct. So, yes, the fundamentals stack up for this asset class. Every investor and the trustees' fiduciary duty is to make sure that their funds perform well financially. So that, is proven. We understand the returns, or the return profile for this asset class. And as far as the issue, I think, like we have, discussed, it's mitigated by, the policy positions administratively, and as far as ultimately will sort out, its challenges. And I think to a potential investor would say, let's use the power of capital. This sector requires, 115 billion to 176 billion by 2025 to 2030. So that's a huge funding gap that it's available for private investors to play in. And what happens is, when we come together and we look at this asset class, and we come with the mentality of we put our money where our mouths are. We invest in this sector, and we are able to engage the government. That is the power of capital, to say, when we put our money here, we need you to resolve certain things. We need policy certainty. We need NSFAS that is fixed and it's operating efficiently. It does what it commits to do. And here is our part. Yeah. For most part in South Africa, we always point at the government, and we take a back seat as the private sector. We need to come to the party, bring solutions, and that solution is bringing the capital, but also helping NSFAS to restructure itself and take some of the financial burden off the government book, and fund it, make it affordable for many, for the majority of these poor students to be able to get a higher education in a dignified, decent manner through the accommodation that we provide. So I think everyone has a role to play. We must collaborate and bring solutions and invest. It's not, you're not opening yourself to a loss a situation here. Yeah. We haven't made a loss.
Sapati, thank you very much. I'm at a loss for words. I think you've all wrapped it up very well. So just a warm round of applause, everyone, for our panel today. And before I let you off stage, I just want to thank Growthpoint Investment Partners as well, along with BD Events, for facilitating a fantastic discussion and a deep dive into an asset class that holds such great potential from just not only financial returns, but to your point, Sapati, about building the South Africa. And as we head into the elections in the next few weeks, I think we're all thinking and reflecting on 30 years of democracy and what we've achieved. And it would be churlish to say that life isn't better, but are we where we want to be? Clearly we're not, but it is up to all of us to get to that point. So thank you again for everyone's participation in the audience and online as well. For those joining us on the Apex Studio Tour, please proceed to the designated departure point, would be just outside in the parking lot over here, and we'll continue to kick the bricks over there. For me, Michael, it's just been a real pleasure being your MC and facilitator today. And with that, if you are leaving, just travel safely, and I'm sure we'll see you at another BD Arena events in the not too distant future. Take care.
Thank you.
Thank you.